All right, so we're going to be doing Chapter 11. I don't know if you know the terminology in bankruptcy court. Chapter 11, you're going to um, you're you're basically starting the process of bankruptcy. So it always makes me chuckle inside when I say, "Oh, we're going to talk about Chapter 11, bankruptcy." But no, really, it's current liabilities. Okay. Current means less than 365 days. So these are liabilities that are going to come due within a 1-year time period. And so the first discussion, talks about accounts payable and notes. And no, we didn't talk about this yet. All right. There's two types of notes. Okay. And so we're going to talk about notes payable. Okay. Notes payable, can be created in several different ways. It could come from we owed somebody something, so we purchased something on account. All right, so we purchased supplies on account, accounts payable, okay, $3,000. Actually, you know what? Let me I'm trying to find an example. I'm going to go ahead and, well, no, that doesn't work either. Well, let me just finish this one, and then I'm going to pick a problem that we can work so you guys can always go back to the numbers, all right? And so, one way to enter into a note payable, okay, would be we purchased something on account, all right? It was 210 net 30, okay? We can't pay it, all right? So then we call them up and say, hey, would you take my promissory note, all right? And so we're going to give them a note. I'm sorry. We're going to give them a accounts payable. I don't know what happened there. Sorry. All right. We're going to give them our notes payable in exchange for that accounts payable, okay, of $3,000. Okay. And so this is one way to enter into a note. Maybe we have a 90-day, so on and so on. Okay. However, another more common way of entering into a notes payable is going to the bank and asking for some money. And so if you look at PE 11-1A, okay, we have a situation similar to that. It says on May 15th, Maynard Company borrowed cash from Texas Bank, issuing a 60-day note with a face amount of $100,000. All right, and so in this case, what we're going to be doing is we're going to be getting cash. By the way, this is A. Okay. We're going to get cash, and we're going to give them our promise to pay note. And in this case, we're getting this $100,000. This type of note is referred to as an interest-bearing note. All right. The reason being is it tells us that, hey, this note was a 60-day, 6% note. By the way, this was written on May 15th. All right. Because, we worked through these, didn't we, last class period? All right. Something similar to this. Basically, what it's saying is, hey, we're borrowing, all right, $100,000 here. This is going to earn interest, okay? And we're going to have to pay back that interest, right, at maturity, okay? 60 days later. And so if we were to calculate the interest, interest is calculated, the face times the rate times time. And so our face amount was 100,000. Our rate is 6%. And our time is 60 over 360. All right, so, this is the same calculations that we did back when we talked about, notes receivable. It's just now we're paying this. Right? And so this comes out to be 100,000 times 0.06 times 60 divided by 360. Okay. So this comes out to be $1,000. And so, over the passage of time, we're going to have to pay back at maturity $101,000. And so, things that you're going to have to be able to determine, right, are the due dates. Yeah, we did cover this, didn't we? All right. The due date of the note. All right, so we're going to start off with the note. This was a 60-day. We wrote this on May, what was it, 15th? All right. May has 31 days in it. Because if you use the knuckles, January, February, March, April, May, all right, it lands in the knuckle. This was written on the 15th, so 15th, which means we're going to have 16 days left. We're going to subtract that from 60, and we have 44 days. Okay. May, June has 30 days. Okay. And so we end up with July 14th. Right. And so on July 14th, we have to pay this back. All right, so we're going to reduce our note payable of 100,000. We're going to have our interest expense. Okay, so it's not revenue. Before, when we talked about accounts receivable, notes receivable, we had interest revenue. All right, in this case, we're going to have the $1,000. And so we're going to have to pay back the cash, right? The maturity value of $101,000. And so you will be having to make, or answer multiple choice questions. I'm pretty sure you're going to have to figure out the due date of a note. You're going to have to calculate the maturity value and understand the journal entries. And so this was what's referred to as an interest-bearing note, okay, where a I don't know what that is. Non-interest note. The textbook refers to this as a discounted note. Looks at things a little bit different, all right? Instead of the timeline thing here, when we enter into a discounted note, we're basically saying, hey, we're not going to pay back the face plus the interest at the end of the 60 days. Okay. We're only going to pay back the face amount. Okay. Well, that doesn't mean we're not paying interest, right? Even though it says it's a non-interest bearing note, okay? Money is not free. We will always have to pay interest, right? But what we're basically doing is we're discounting this back, right? into today's, okay, we calculate the interest. Well, we did the calculation already. It's $1,000. Okay. And so this is what's referred to as the proceeds. The proceeds of this note, all right, are going to be $99,000. And so what we're going to do is we're going to receive cash, right, of $99,000. We're going to have our interest expense of $1,000, and then we're going to have our note payable of $100,000. This is May 15th. Where, what do we come up with? It was June 14th or something? Or July 14th? What was it? July 14th. On July 14th, okay, we're going to pay back this note. All right, so we're going to reduce our note payable and cash for $100,000. Zero. All right. And so whenever a problem asks for you to calculate the proceeds, right, really what they're talking about is they're talking about a discounted note. A lot of times they'll say the discount rate was blah, blah, blah. All right. And so that's how you will be able to identify the difference. So if they're asking for the proceeds, they're asking for a discounted note. If they're asking for the maturity value, right, they're asking you for the normal note. Right. Cool. Any questions about that? All right. Then, as I said, the next section deals with payroll. So let's put your line across here. All right. Part 2 deals with payroll. Okay. And so there's a lot of reading there that you can do. All right. You know, understand that when it comes to payroll, okay, there's really 2 parts to it. Okay. There's the employees part, and there's the employer. Oops, don't know what that is. The employees and the employer. Okay. And so there are ultimately 2 journal entries, okay, that we're going to have to record, right? One for the employee and one for the employer. Okay. And this is the cost of doing or having employees. And so, like I said in the videos, I do a lot more with the you know, the content here. Okay. But really, what I wanted to highlight is that there's, for the most part, 2 journal entries that are derived out of payroll. One for the employees, which is going to be their salaries and wages expense. So expenses, if you remember, are debit. Okay. This is represented by their gross pay. Okay. That's their gross pay. From that, okay, and this is what the chapter goes through, all right, we're going to have some deductions. All right. First of all, we're going to have the employees tax or income tax. What's this chapter about? This chapter is about payables, liabilities, right? And so this employee income tax payable is a current liability. Okay. There's a huge calculation based on your W-4, okay? And we walk through that in your textbook, or I mean in the videos, all right? Highly unlikely that you're going to be asked to calculate the employee's income tax payable. You need to know what that is, all right? But it's a pretty long and drawn out calculation. So you are not going to have to learn how to calculate Next is you're going to have FICA, Social Security payable, all right? This is your Social Security, all right? So every person that is employed as an employee, they have to contribute, all right, half of the FICA Social Security. Along with that, they also have to do the FICA Medicare. Okay. This is also a liability, okay, because we do not get to keep that. We, the employers, because we're the ones who are making this journal entry for our employees, we act for these three things. Actually, we act as the agent for the federal government, all right? And we withhold this from our employees, and then we ultimately mail this on, all right, to the federal government. Okay. We would probably have some state, income tax withholding. We really don't get into that because the states are different depending on which state you're in. So we're just going to leave that one alone, right? But there are some others, okay, that we would withhold. Maybe it's the employee's portion of their medical. Maybe it's retirement savings, right? There's a plethora of different things, right? But again, this is still a liability. We, as the employer, do not get to keep that. Right? And so we're subtracting all of these things from our wages expense to come down with our wages, our salaries and wages payable. Okay. This is our net pay. Okay. So this is what's derived as our net pay. So that would be an example of the journal entries, all right, that we would record for our employees. The the calculations of all of this, we'd probably be using a payroll register and what. Okay. From that same information, however, the employer is going to have to make some journal entries. Right? And so the employer, all right, is going to have this payroll tax expense. Okay. And in that, they're going to have to match, all right, the FICA, Social Security, all right, the FICA, Medicare, okay. And then they have two other ones. They have the FUTA, okay, which is the federal unemployment, okay, and the SUTA. And so these are all payables. Because this whole chapter is about liabilities, all right? And so, again, this journal entry here, okay, really is the cost of having employees, all right? And so the cost of having employees is that the employer has to pay all of this, okay? And so, today, okay, with our pandemic, all right, this is really our unemployment. Okay, I ran out of room. All right, unemployment. And this is a big deal right now because so many people are being laid off from their jobs. What this program is intended to do is to, help people to survive. To be able to buy groceries and pay their rent and things along that line. All right, and so as the employer, okay, is using up the value of these employees, this is the cost that the employer has, all right, to carrying employees. I did talk about this in the video. Some employers try to get out of paying this expense, okay, by treating people as subcontractors, all right? There are some specific rules, all right, between a subcontractor and employee. Basically, if your employer treats you as a subcontractor, you end up paying both sides of the FICA. All right. So you'd have to pay, the employee's side and the employer's side because you're self-employed. If you're a subcontractor, you're considered in the eyes of the government to be your own business, and so therefore you have to pay both sides of the FICA. All right. So yeah, spend some time on there. Okay. Then gets into talking about pensions. You can read that, vacation pay, contingent liabilities. All right. Contingent liabilities. Okay. There's a really good exhibit. Let's see, what is it called? Exhibit 8. Oh, whoa. Yeah, shoot. Hang on. Control. I had to grab my, whatever. There we go. Too far. All right. Okay. Contingent liabilities. There's a good exhibit. Um, 8. Okay. That walks you through a contingent. All right. Now, what a contingent liability or just a contingency is something in the future is going to happen that will impact us today. All right. What a real life example of that, and a common example, are product warranties. So if you make a television set, all right, and you give a 90-day warranty on that for any manufacturer of defaults, all right, you may end up having to fix some things in the future. All right. And that's what the textbook really runs through as far as the contingent liabilities. All right. But the one that I like to use is a lawsuit. All right. Somebody is suing you. Okay. So, the little scenario, and I did share this in the video, but, we have a delivery driver who was texting and driving, and he hit somebody on a bicycle. They live, all right, they don't die. I used to say that they died and the family sues, but that was just too dark. So the bike rider lives, but he ends up suing you, all right? And so here's the deal. You have a timeline, okay? This is 2019, 2020, all right? So, the accident happens here in 2019, all right? You go to court, all right, okay, in 2020. The problem that we have is on December 31st, okay, we have to make our financial statements, okay? So the question is, all right, are we going to have to pay, this guy that we hit, all right? Or are we, going to get out of this, all right? The contingency is if we lose in court, okay, we're going to have to pay. But if we win, we don't have to pay. The problem is we don't know, all right, what that case is here at December 31st. All right, we don't know, and so we have to make some guesses. All right, and so in order to make a journal entry, okay, so we have lawsuit, expense, lawsuit, payable, and this could be worded any way depending on really what it is. All right, but it's an expensive. We're making this on December 31st. Okay. Well, in order for this journal entry to be made, two things, okay, two conditions, okay, have to be in play. All right, and that's where this decision tree comes into play. This exhibit number 8. And so we have this contingency. It's a lawsuit. All right. We go to our lawyer. Okay, and he says you're probably going to lose. Okay. you're probably going to lose. This is more than 50%, right? Probable is more than 50%. Because if it was 51%, you're probably, that's more than 50-50, right? You're probably going to lose. All right, so that's the first condition. Right? And he says you're probably going to lose $3 million. He can give you an estimate, right, of how much you're going to have to pay. Okay? If that's the case, we have enough information, right, to make the journal entry. Okay, it's probable. Okay? It's probable, and we can estimate it. Okay, we estimate in this case, and again, this is probably coming from your lawyer. Okay, $3 million. Right? If that's the case, we have to make this journal entry. However, if he comes and says, yeah, you're probably going to lose, all right, but I have no idea how much you're going to have to pay, all right, can you make a journal entry, if he doesn't have a number? No, you need to have a number in order to make a journal entry, all right, because that's, the numbers, right? You need that information, right? So if he came to you and says, like, I don't know, you could lose $1,000 or you could lose $3 million. That doesn't help you, because what kind of journal entry are you going to make with that? 1 to 3 million? No. Or 1,000 to 3 million? No, you can't make a journal entry with that. However, you need to disclose that information, all right, in the notes to your financial statement, right? This concept is referred to as full disclosure. You need to be clear that, yeah, we're currently in a lawsuit. We can't estimate how much we're going to have to pay, but we just want you to be aware of that. Going back again to our Exhibit 8, right, which is on page 557 if you do have an electronic textbook. The second issue, we have the same scenario. We hit the guy, all right, but it's really kind of unclear whether it was our fault or if the guy hit a stone and his bike got thrown into our van. Who knows, all right? But your lawyer says, yeah, it's reasonably possible we may have to pay. Okay, so reasonably possible is really kind of saying anything that's under 50%. Okay, down to maybe like 25%. They don't really give you specific percentages, right? They just say, yeah, it's possible. It's possible we could lose. And again, that's your lawyer telling you that. Okay? Well, if that's the case, you do not need to make this journal entry. Okay? However, you do need to disclose that information, all right, in the notes to your financial statement. The last likelihood of occurrence, right, is this thing called it's remote. All right, the lawyer says, this guy is a known scam artist. We have footage of him, diving into the side of our delivery van and claiming we hit him, and I have video of him walking around without his neck brace on, whatever. He says, you're not going to have to pay this, right? If that's the case, we don't have to do any disclosure at all. Well, the last bit of this chapter, okay, deals with financial analysis. Financial ratios, all right? And again, with financial ratios, they're only as good as what you can compare them against. Right? And so there are 3 financial ratios, okay, that you need to be aware of. There's working capital, and working capital is current assets, right? Subtract current liabilities. Okay. And really what they're saying is, hey, if we took all of the current assets and paid off all of our current liabilities, what would we have left over to work for us, to continue growing our business, right? The next one is the current ratio. That takes the same information. It says current, I don't know what that is. It looks like a 6 to me, all right? The current assets divided by current liabilities. All right. And this basically says or communicates, how many times could you pay your current liabilities off? All right, with excuse me, with your current assets. How many times could you pay your current liabilities with your current assets? Then the last one is the quick ratio. This takes cash, marketable securities, and accounts receivable, and divides those by your current liabilities. All right. Cash, marketable securities, and accounts receivable are referred to as your quick assets. And the reason being is you can quickly turn those into cash. Cash is cash, all right? Not a big deal. A marketable security is a publicly traded investment. So you buy a share of stock, all right? Well, you can convert that into cash by just picking up your phone and calling your broker and saying, hey, sell that piece of that asset, all right? And you're going to get your cash. Accounts receivable, you can actually turn those into cash by selling your accounts receivable. There are financial institutions out there that will buy your receivables from you, okay, and give you cash. It's called factoring. That process is called factoring. And we divide that by your current liabilities. What this communicates is a company's ability to pay off, all right, their liabilities with their most liquid assets. And so there's an example, all right, and I just want to use this example in the textbook. They look at the difference between Dunkin' Brands Group, right, Dunkin' Donuts, and Starbucks, right, and so they show us, all right, that, and let's just use the current ratio. All right, Dunkin' Donuts, they have a current ratio of 1.3. Okay, 1.3. Whereas Starbucks, they have 1.2. Okay. So, all right, if I were just to ask you, hey, if Dunkin' Donuts has a current ratio of 1.3, is that good, bad, right? Is it better? Is it worse? If we're just looking at this, you really don't know. All right. It does tell you that we can pay off our current liabilities 1.3 times with our current assets. But it really doesn't tell you that that is good, bad, or better, or worse, all right? Because if last year, let's just say last year, it was 1.5, okay? Is that good? Again, you really can't tell if that's good, all right? Because to know if something is good, you got to compare it against your competitors. I can tell you that this is worse than last year, because last year we could pay off our current liabilities 1.5 times, and this year we can only pay it off 1.3. But to find, so better or worse, you want to compare from year to year, okay, internally. You want to compare. We're doing worse than last year, okay? However, we are doing better than Starbucks, all right? And so to find out if something is good, all right, or bad, you want to compare it to your competitors, all right? I typically wouldn't think of Dunkin' Donuts as being a competitor of Starbucks, but I guess Dunkin' Donuts does have their own coffee line and whatnot, okay? But with this information, Dunkin' Donuts is good as you compare it to your industry, right? Your Starbucks, because Starbucks can only pay off their current liabilities 1.2 times. Does that make sense? I hope so. Okay. Well, that's about all I have for as far as the content, right, let me stop sharing or stop recording.